So I'll start at the beginning. I think that the stock market reflects human nature as much as it does underlying fundamental value. And human beings have a tendency to excess. And we all know about that because we all experience it in our own personal lives. If you think about it, you know, some Monday mornings we wake up and we're full of vigor and vitality and we think we could take on the bloody world. Especially if you're a bit like me and I'm in love with motivational books and if I've listened to Tony Robbins or Zig Ziglar or more recently The Secret. But then of course there's those all too human other Monday mornings we wake up, we're moody, we're depressed, we don't want to take on a lot of life's challenges. And when you really think about the stock market, it's nothing more than a place where many, many, many human minds come together to decide at what price they're willing to transact stocks that day. And we bring with us ourselves into that pricing decision, and our human emotions get translated into stock prices in multiple ways. But I think one of the most fundamental ways is a phenomenon that psychologists have long called groupthink. Where it's known, we will behave much more outrageously in the safety and comfort of a crowd or a group dynamic than we would ever consider doing on our little old lonesome. And I think that largely explains why individual stocks and markets as a whole and sectors will from time to time trade at euphoric highs and depressed lows well above and well below long-term true net worth. And as a value manager, we're going to try to take advantage of that human dynamic in the market. And by presumptuously constructing as disciplined a process as I can put upon myself and my team, attempt, and I want to underline the word attempt, to help us stand aside from that fray of human emotionalism. And by looking at the long-term historical fundamentals of stocks and how they've tended to trade relative to the market throughout their history, predict how they're likely to behave going forward in the future. And value managers like to call their predictions intrinsic values. In more layman's terms, you might call it a long-term true net worth. And value managers believe in reversion to the mean. Our best guess at any point in time is that a stock will tend to revert to its intrinsic value or long-term true net worth. So we don't ask stocks to go places they've never been before. We try and buy stocks with a bit of history and then just wait for them to do what they tended to do in the past. And we have to do some work to make sure that is possible for them to do what they've tended to do in the past. And if they do that, we should be able to get low-risk returns for investors. And we really focus in on that risk component. So let me just move ahead a bit on the presentation. I should have figured out how to use this before I got up here. We're fine. You know, we're really focusing on risk-adjusted returns. You know, here's a stock, you know, trading around its intrinsic value. And when it's trading significantly below, we don't know when, we don't know how. But if the risk factors are acceptable, more than likely that stock's going to eventually revert back up to its mean. Conversely, when it's trading significantly above its intrinsic value, like Nortel in the summer of 2000, trading $124, didn't know when, didn't know how, the more than likely financial gravity was eventually going to grab that stock and drag it back down to a more normal valuation level for itself. So it would be a stock to avoid. So here what we're trying to represent is, you know, value managers like to buy $1 and, you know, for at least 60 or 70 cents and then just patiently wait for it to go back to $1. The overall market has a positive and optimistic bias. And because it's forward-looking, most of the time the market's willing to pay a premium for intrinsic value. And we find, looking at our models, that the average stock tends to trade about $1.20 to $1.30 most of the time. Not today, which makes today a very interesting time in the market. And so to us, intrinsic value, or $1, becomes the first sell point. And then we step back and we say, from our perspective, is this a high, low, or moderate risk stock? And if it's a high risk stock, let's take our profit at intrinsic value. But if it's low or moderate risk, let's sell a bit here at intrinsic value, but let's farm it out a little bit. Let's sell a bit at $1, a little bit more at $1.05, a little bit more at $1.10, a little bit more at $1.15. But as it's getting further above its intrinsic value, we want our position size or our risk exposure in that name to be diminishing. So we're not going to be out there on a limb with a name that's above its intrinsic value. And those of you who've read Fooled by Randomness or The Black Swan, he talks about the skewness in the market and how you can make outsized returns taking advantage of the skewness of the market. It's rare for the market or individual stocks to be trading below its intrinsic value. It's much more common for it to be above. And so, you know, we got the opportunity to buy below intrinsic value. Let's not sell it too fast as it's rising above. How do we determine intrinsic value? We purchase outside data banks and we download information focusing on 3 key factors to determine intrinsic value. And that's book value, a valuation metric, historical return on equity, an earnings machine capability metric, and relative price to earnings multiple, a how have you tended to trade relative to the market metric. And I would attribute the mosaic nature of that calculation with the consistency of our returns. And you know, O'Shaughnessy's book, What Works on Wall Street, I think he captures that very well in the early part of his book, where he says, you know, if a value manager relies far too heavily on just 1 or 2 key value ratios, you have the potentiality of going through long, dry spells of underperformance. And given career risk, you might not have a job or any client base. So he talks a bit about adding momentum to, you know, get your timing more accurate. Well, we've tried to do that, and we couldn't find a way that seemed to work for us. But we found that using this method, which is sort of a mosaic method of looking at the numbers, has been very helpful, and we have avoided so far, touch wood, you know, long dry spells of underperformance. What I'll do is I'll go into each of these in a little bit of depth so you get a good idea of how we manage money for our clients, and then go on a bit further. Book value. And keep in mind, we operate in Canada. In our method of investing, we call relative value. I consider it pragmatic to the Canadian marketplace because we have a very idiosyncratic marketplace. Canada is one of the most resource exposed of the major markets in the world. And so in order to you know, consistently outperform, I believe you have to play the game a little bit differently than if you were in a deeper, richer, fuller market like you find in the US. So we've modified the method of value investing to work well in the Canadian market. Book value for Canada. The TSX, as it is currently composed, has comparable data going back to 1956. There was a market prior to that, but it wasn't composed in an index in the same way, so that the data you can use to research in Canada only goes back to 56. Since then, on average, the price to book value for the Canadian stock market is 1.60 price to book value, and that's been rising over my career, and it's only been dipping again recently, so the numbers might pull back again in the future. But rising over time in my career, I believe largely due to the degradation of accounting policies over time. Now, value managers are famous for liking to buy stocks trading below book, and we like that too. But for most of the last 15 years, it was virtually impossible to build a fully diversified portfolio of stocks all trading below book. And you would have had a very strange portfolio, and it would have behaved very differently against the index. So we modified that, and we said, we will buy preferably stocks trading below 1.5 price to book value, which is the history of the TSX. If we can find them below book, that's great. But if we can't, we'll try and get them below at least 1.5 price to book value in the overall portfolio. Second key factor, historical ROE. What we're trying to capture here is the earnings machine capability of the firm. All other things being equal, rational investors would value more highly and pay more for machines that can produce more good things like above average earnings and profits and cash flows and high sustainable ROEs than you would for machines that produce less of all of those good things. For me, the standout for high sustainable ROEs in Canada has to have been Rossmann's, a cigarette manufacturer. And it got taken out, I guess, about a year ago in the marketplace. It's kind of a shame to see it gone. But its 10-year historical ROE when it got taken private was probably on average a 40% ROE. And in fact, it was probably a 40% ROE over the last 30 years. And so incredible earnings machine capability firm. And you can imagine you'd pay more for that capability than you would for a machine that produced less ROE. And unfortunately, in any marketplace, there's lots of candidates for low sustainable ROEs. But for me, one of the really obvious ones, and I like to talk about it even though the example's getting a bit dated because everybody's familiar with it, and that's Hudson Bay Company. And it too was taken private about 3 or 4 years ago. And when it was taken private, its 10-year historical ROE was about 3.5%. When companies have a life cycle, and in the early stage of their life cycles, they tend to, have very high ROEs. They found a new business niche. They may be the only player in it. They're getting above average profitability, very high ROEs. Of course, that will attract competition. It'll take away that excess ROE until you revert back to a normal market ROE, roughly 9 to 12%. And then hopefully you maintain that for a long period of time. And then eventually for almost all companies and industry groups, you hit a sunset phase and eventually, unfortunately, a death phase. And we can argue in North America, the department stores have definitely gone past their maturity phase, are now in their sunset phase, and clearly a lot of them have been in their death phase. I mean, in Canada, we've lost in my career, Eaton's and Woodward's, and Hudson Bay Co. is still alive, but struggling somewhat. So in terms of capturing this, I call it almost a bond-like quality in equities. It's sort of this capturing this yield of earnings ability. How we capture this phenomena, embed it in our model, is we take a 10-year average historical ROE for each stock in the universe and we plug it into the model. Now we will go in and modify this number from time to time based on fundamental analysis, but we won't deviate much from history. So we'll take that 10-year average and we'll move it up a couple of notches or down a couple of notches based on what we see has been happening in the firm. The most common adjustment is that we're taking it down. If I see a 10-year 20% ROE, we're looking for reasons to take it down because there's one of the most mean reverting series of numbers is ROEs. And we know they're going to get dragged down to 9 to 12 ROEs. It's actually 9. People don't usually believe me on that, so I sort of give it a little bit of slush point. I say 9 to 12, and they seem to be happier with those numbers. Relative price to earnings multiple. What we're trying to capture here is how has this stock tended to trade relative to the market throughout its history? Has it tended to always trade at a premium multiple to the market? Or has it tended to always trade at a discount multiple to the market? Or where in the continuum? And there is a tendency, and it does stick with that tendency. And I like to point out to people that it tends to move off that tendency at a snail's pace. So this is not a number you wonk around a whole lot. And the best way to illustrate this is through looking at industry groups. And I'll use two very contrasting industry groups. One is the banking system. The banks have always traded at a significant discount to the market price to earnings multiple. Generally speaking, the rule of thumb in Canada is that banks trade at 2/3 the market PE multiple. So whatever the market PE multiple is today, the banks are generally trading about 2/3 of that. And the reason why is because the market will pay more for consistent earnings than it will for volatile earnings. And banks are considered economically sensitive due to their interest rate sensitivity. So they're going to have volatile earnings patterns, and because of that, you're going to pay a discount for those volatile earning patterns. The polar opposite is a sector that has always had a mythological quality around it, and that's the gold sector. And people always want to pay a premium for gold stocks. And I'm a value manager. My whole career I said, this time it's finally going to be different. They're going to revert to the mean. They're going to get cheap. But they haven't yet. And actually, I have a current theory that says with ETFs, we're finally going to get there someday. But it's snail's pace. It'll take a long, long time. But gold's normal market PE multiple over very long periods of time is roughly a 14 PE multiple. Gold stocks traditionally have traded at 20 to 50 PE multiples. So that sort of gives you that kind of differential. So we take all of these key factors, we calculate, we have a proprietary model, we calculate an intrinsic value for each stock, compare it to the current stock price, calculate a 2-year hence expected return, then we rank the entire universe according to cheapness, and we focus in on the first 2 pages, the 140 cheapest stocks in the universe. So it's a rude, crude, rough and ready ranking machine that we use. Nothing more, nothing less. The model's only as good as the inputs. But it's a great efficiency tool. It says, these are cheap. You better go do your homework and make sure they're cheap and make sure they make sense for you. But, you know, somebody can call you up and say, well, brokers call you up all the time. Hey, you should look at such and such a stock. Take a quick look. My model doesn't like it. It's a very simple model. I can sit there and go, yeah, no. And just test a few of the numbers. Nope, they all seem pretty legitimate. Nah, we're not going to bother spending time on that stock. That's not one for us. The data banks refresh data weekly these days, which is lovely. And so we refresh the whole model and redo it every week. I get a new one on my desk every week and everyone on the team. But if there's, we like schisms in the market. So when you had, as we did in November, a minus 9% day, whoa, we're coming in the office early in the morning because they refresh all the data overnight. And we say, punch it out with the new prices. And we're really keen to see what's relatively repositioned in terms of attractiveness and try and jump on it really quickly. And that's when the efficiency of a model like this really comes home to roost. That, you know, instead of just, you know, in Canada, I would argue there's probably about 800 publicly listed stocks. Well, there's 1,200, but a lot of them are pipsqueak. You know, instead of trying to go, is that one cheap? Is that one cheap? Is that one cheap? The model efficiently says, these ones are the cheapest ones, and you just go from the top to the bottom and go, oh, that's a neat one. I really like that company. It's never been this cheap before. Let's go do our work really fast. Let's consider buying that. And we're also watching for what's marching up the page, and we want to, before it enters a buy zone, let's start doing the analysis and start getting ready to buy it in case it gets there. So here we are, the investment process narrowing down. We start with the quantitative method, and then we move to a fundamental approach because numbers alone can trick you, as you all know. And so we have to go in and stress test those key numbers. So the model, if you will, is metaphorically plucking numbers blindly off financial statements with no judgment going into it at all. And it's up to us to go back and say, what are the key numbers the models are using, and making sure the numbers they're grabbing accurately represent what's going on, and then plug it in. And then if we agree that that's the case, then consider putting them in the portfolio. So to capture this fundamental analysis, and I'm going to really simplify it down, and maybe in the Q&A we can go into a lot more depth on this. But I would say that financial statements, to me, are as much a marketing document as they are a statement about financial facts. And there is a story that a management team is trying to tell about themselves, and we want to get in there and take a good look at what kind of story. And we read financial statements, in particular the notes to the financial statements, that's the fine print at the back, looking for signs of human excess again, but human excess in corporate management. And we're looking for signs of excessive levels of boastfulness versus excessive levels of modesty. Now, the business world is really competitive, so I'm not going to surprise any of you in the room that there's a lot more boastfulness going on in financial statements than there is modesty. And boastfulness can be found through examples of aggressive accounting practices. And I'm going to simplify that by saying aggressive accounting practices in aggregate are basically attempting to make earnings look better than they arguably really are, so that we'll all pay more for those stocks. And so we want to look for signs of aggressive accounting, and if we find it, then we have to measure the degree to which we think it's being practiced. Is it egregious? Is it, is it 30% overstatement of earnings? Or is it garden variety, run-of-the-mill, 5% overstatement? And it is an art, not a science, to try and determine what that is. And what we'll do is if we think it's there, instead of demanding a 30% expected return to enter a stock, which is our normal entry point, we step back and say, how about we need a bigger, fatter margin of safety before we'll buy these stocks. We need something more like a 40 or 50 or 60% expected return, given that the risks are much higher. So we will buy companies that do practice some aggressive accounting if we think that it's measurable and we can get our hands around it. If, however, there is so much aggressive accounting that we really don't have a good handle on what this firm is worth, you can't consider buying it. It's really beyond the pale. And so we'll avoid those stocks altogether. We'll just say that one's on it. We can't really figure out what it's worth. It's just too gray zone. And it's libelous to talk about that while it's being printed, so I won't go into any Canadian examples while the film is rolling. We do interviews. I'm not going to go into our corporate interviewing techniques because I don't think we do anything better than anybody else, although as a value manager, we're probably more afraid of falling in love with the management team than other teams are. So we want to meet with management, but we want to keep our distances so that we're not too emotionally entwined with the management team. And then we use a very structured questionnaire template. It has approximately 20 questions. And under each question, there's a number of sub-questions. It's a fabulous training tool. When we bring in somebody, the first thing we do is we say, okay, start analyzing. Here's the template. Here's the company. Go. And we ask everybody to have a recommendation at the end, although at the beginning, for the first 2 years, their recommendations are all over the place. But we can read it and sort of say, based on what you've done in the work, and we can ask you a number of questions, we really know what the recommendation should be at the end of this. But over the years, they can look back and say, gee, I didn't do such a bad job for my first or third report or whatever. But it makes sure that we look at each company 360 degrees around, that all the stones that should get turned over do get turned over in a very disciplined way. And also, if we go out into the world and we learn more about how the investment world works, and we say, gee, that could really add to what we're doing. One of the problems is a lot of people find out great new ideas, but they don't know how to get it into the process, especially when you're working in a team. By plugging it into our questionnaire template, we instantly plug it into our methodology and get it employed and not forgotten and used in our methodology. So our style is constantly evolving and enhancing over time. Based on our George's input, he said we should use an example. I don't often do this. I actually try and avoid speaking a lot about individual stocks because I consider myself a portfolio manager. And I hate just talking about one or two stocks, and people walk away with the impression that we own those stocks. And depending on how that one or two stocks does in the next year or two, and a year or two is actually not a very good time horizon to judge our skill, they'll make judgments about us. But for this example, of course, we're going to use an example that works in the short term. We think that in this kind of environment, a food retailer is a very stable way to play a very volatile market. No matter what, people are going to go out and buy food. And especially in a tough economic environment, you may stop going into restaurants as much, and you might do more food shopping at a grocery store, so their sales could potentially be up in a bad environment like this. And this was a uniquely inexpensive food retailer. People were quite concerned about Walmart entering the marketplace and stealing market share in Canada, so you got a chance to buy food retailer as well. And the arrows show the time horizons which we bought, and we tend to do incremental buying and incremental selling. We're not an all or nothing, buy in once, one day, sell out once, one day. So we still are long Metro right now. Yes, sir?
Why did you buy in January, February, or February, March of 08?
it could be relative to everything else. At the time, there could have been better candidates. We could have been buying another food retailer. We own a couple of them. So, but, you know, it just so happens you don't always, believe me, you don't always buy at the bottom and you don't always sell at the top, and you can still make decent returns. There's lots of choices that are being made in a portfolio at any time. And I don't remember the specifics of that particular time horizon. My analyst would. He would remember in very good detail. Mel would be in here going, well, the reason why, or he might have written the report in the summer and, you know, be completed at that. We could, you know, completed it, and then we were all ready to do. We also take the view that we try not to buy or sell anything unless we're fully up to date on our homework. I think to blindly go out there and buy things or sell things can get you into trouble. Now, almost every fund manager has a how they sell, and I think it's because everyone gets so enthusiastic about the buying and and I started out as a trader. I was a trader analyst for the first 5 years of my career. One thing that I think is really hard to capture in a classroom is how psychological trading really is. It is unbelievably. I think it's my background as a trader has really made me aware of the human element and the emotions of investing. And buying is the easiest thing in the world. Selling is the hardest thing to do psychologically. And so most fund managers are asked how they sell. And I think there's really only 3 times that we sell. The first one's ideal. It unfolded exactly as it should. We made our intrinsic value return. Life's wonderful. We're heroes of the universe, and we sell. The second one is much more common. It's a switching, where the stock sort of probably made its move. It's doing the right thing, but another stock has suddenly, in the same sector or industry, has gotten a lot cheaper, has much better attributes, and has a longer future ahead of it. And you may well sell your stock even though it's a wine that hasn't fully matured, and replace it with one that has much more future potential with much less risk. And this works really well in markets that are challenging. Like in really expensive markets, you're a value manager. There's not much to buy, ideally to buy. So you're not rotating your portfolio that much. But something else is getting sort of half cheap and is relatively better, then you can sell the slightly more expensive name and pick up a name that has a bigger future, even though it doesn't have a minimum 30% expected return. The third one is we have to all admit that we make mistakes from time to time. And once in a while you realize this stock, you made a mistake buying it, or some new development has occurred and it doesn't have the future you thought. And the sooner you just admit that and move on, the better. And probably our best challenge to ourselves is we ask ourselves one question, which is, if you knew everything you knew today about this stock and you had a fresh new portfolio to start today, would you buy this stock and put it in your portfolio? And if the answer is no, then why do you still own it? And it's sort of coming at the question psychologically different. And we're talking about how difficult it is to sell psychologically. You made the decision to buy it at once upon a time, and now it's a mistake, and it's hard to admit that to yourself. So come at it with fresh eyes. If you had it to start over again today, are you desirous of putting this into your portfolio today or not? And if not, then get out of it. Move on. Drive on. And then this is just sort of, it covers some of the risk management and managing a portfolio. Having a lot of names. We generally hold about 40 names. A fallout of value investing is that you have above average dividend yields. We actually follow portfolio characteristics. We like to see that a portfolio overall is 10 to 15% less than the index on price to earnings, price to book, price to sales, price to cash flow, and above average on dividend yield. We actively avoid financial risk. Companies face 3 major forms of risk: cyclical, operational, and financial. As value managers, I love cyclical and operational risks because they give us the chance to buy great companies cheaply from time to time. And I'll accept those kinds of risks day and night. Financial risk, a management team always gets to choose to take on some extra debt. It's their choice. But if they're out there on a limb financially, it means it's harder for them to sail choppy waters if they get hit by cyclical or operational risks. And what ultimately puts company into bankruptcies? Financial risk alone. But it's financial risk combined with the others. And wouldn't you know, you get out there on a limb and everything starts going wrong. So that's something that's easy to control as a fund manager. So we actively avoid financial risk in the companies we buy as much as possible. We've already talked about aggressive accounting. I've already talked about incrementalism. Predictable earnings. Using this method of investing, if we see a company, we'll go in and actually look at the data series. When we're buying a company and its ROE over the last 10 years has been incredibly consistent. Let's say when you look at that 10-year series of numbers, the ROE is as low as 8 and as high as 12, and the average is 10. Well, that's really consistent. And my ability to predict the future based on that is going to be pretty good. So our confidence level that the stock's going to do what we think it's going to do is higher. So we can take a bigger position in a stock like that. Forest product stocks, for example, are soup to nuts. Bad years, negative double digit. Good years, positive double digit. Average 8. How predictable is that 8? Not very predictable at all. So our confidence level, low. Ergo, buy small positions of it. Still take that risk, but don't make it a big part of your whole fund, because we're risk managers. So I'm trying to capture that phenomena right there. And we generally have low turnover. Now I'm giving you more the institutional class presentation because people are really interested in how you manage your portfolios. So this kind of chart talks about how we work together as a team and how we communicate together as a team. So we meet every morning. We assign different reading materials. I, for example, read The Economist. Somebody else reads Barron's. I read the Globe and Mail. Somebody else reads the Financial Post and the Wall Street Journal and the London Financial Times. So we all read these various publications. We go to different lunches. We have different analyst meetings. We visit different management teams. And the morning meeting is the place where we come together every day and download what's relevant to the overall portfolio. We are sharing information on a daily basis together every morning. Then once a week, for us it's Tuesday afternoon, we do research meetings where we cover off those research reports I was telling you about, the 20 questions with a number of sub-questions. Somebody comes in and says, I think we should buy or sell such and such a stock. Here's my thesis. We debate it. We conclude whether to act or not and what price levels and things like that. And then once a month, but for every fund it's every other month, we do an all-day portfolio construction meeting. And I think portfolio construction is the overlooked workhorse of fund management. Everyone talks about stock selection because it's kind of exciting. It's the juicy side of investing. So everybody's totally focused on stock selection. How did you decide to buy that particular stock? And I find very few people talk in great detail about the actual construction of the portfolio and how you manage the construction of that portfolio. What are the weightings of your sectors? What are the weightings of the individual stock names? And what I think a lot of people overlook is that prices of the, you might start off by saying, we want this stock to be 3% of our portfolio. You put it in, and then do you forget about it? Well, you shouldn't, because the pricing will change the relative weight of that name in your overall portfolio. I'm going to give you a good recent example. Last year, we owned another food retailer called Empire. It's really Sobeys. And last year, I think it was one of the few stocks that had a positive return. It was up a little bit over the year. So it was one of the best returning stocks last year. We've owned Empire off and on over several years, maybe more than a decade. and one of the stocks we like. And it was also a classic value stock a decade ago. And we didn't really add to the stock last year. But it ended up becoming our largest relative bet in our overall fund by the end of last year. Because it stood still, and the overall market fell 35%. And so even though we hadn't added to the position, its relative weight went whooshing right up. And at finally, in about November or December, in a portfolio construction meeting, it was number one. It was our number one largest relative bet in the overall portfolio. And we said, as much as we like Empire, it isn't our very, 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 very best idea out there. So let's sell some. And that's one of the beauties of those portfolio construction meetings. That we're trying to look at the portfolio. We're trying to trick ourselves mentally and look at it from multiple angles and say, does this reflect our current thinking? And if it doesn't, because of price movements, let's get it back into whack. Let's get it back to, if we were starting with a fresh portfolio today, would all these positions be where they are in our portfolio right now? And we shift. We do a lot of trading based on that. All incremental, of course, because our turnover is quite low. And then how do we do the workload? We divvy up the market into industry groups, and we take responsibility for industry groups. And fund managers have total control on their industry groups, and analysts are all shadowed. And all their decisions have to be vetted by the fund managers. And then I'm sort of the traffic cop. I consider myself the quality control. And I just make sure that the method is constantly being applied on a consistent basis over long periods of time, and make sure we're all rowing in the same direction. We're giving the same product that we sold to investors, 10 years ago is still the same product basically that they're getting today. So like if you're looking at the historical track record, you're buying it today. And there is drift for other people. So now I'm going to give you a bit of market history on the markets and give you a sense of where I think we are now. And this is a bit of I stole a lot of the speech I gave to the CFA Institute in Toronto in December on value investing here. This chart comes from Jeremy Grantham, who I'm a big fan of. And what this is showing, there's a bunch of different charts, but when we try and understand the market, you often, you'll turn to the TV or the media, and they talk about the economy. And so many people talk about the economy and the stock market in the same sentence a lot. And so a lot of people, no big surprise, walk away with the view that, the stock market and the economy are highly correlated. And they're actually not. And it's kind of one of these interesting ironies. So you'll hear a lot of value managers say, and I will say it too, is, I don't care where interest rates are. I don't care what the political situation is. I don't really care where the economy is. I don't need to know any of that stuff. And I can build portfolios that I think will reasonably consistently outperform the market. And, have fun with that, saying that to audiences, and it's true. But I think that this chart really captures it well, is that what he's pointing out is that the stock market is reflecting at its core, in some sense, GDP growth, the growth of the overall economy. And the growth of the overall economy is, basically in mature economies, roughly 3% growth per annum, up and down in a volatile fashion due to economic cycles. But it's pretty steady, as you can see on the chart, the GDP growth for the U.S. And by the way, I show a lot of U.S. data, and I try and bring it back to Canada. The reason why I show U.S. data is it got a more consistent history over a longer period of time. Canadian data on a consistent basis against the index only goes back to 56, just not enough time to make a lot of forecasts about human nature and how we behave. And then he has the fair value model, and he's basically using the U.S. Federal Reserve model here. And with perfect knowledge of what the actual earnings of the market was, what would you assume that the market was worth? And you can see it's saying 2/3 of the time the fair model is up or down 1%. 2/3 of the time GDP is up or down 1%. But the stock market's way more volatile than either of them. It's up or down 2/3 of the time, it's up or down almost 20%. So the stock market is more irrational than the underlying fundamentals. And then a lot of people focus on earnings. You know, a lot of people, growth at a reasonable price. You know, that's earnings at a reasonable price, basically. But you can see from a chart like this, and this is from the Shiller data, that, you know, yeah, there is some maybe minor correlation, but not highly correlated. It doesn't really explain all those dips and movements. And further, interest rates. Some correlation, absolutely. It doesn't explain a lot of what's really going on. So what does? And I still think it's largely human nature and fundamental value of the individual stocks. And I know you guys all spent a lot of time with your professor on, you know, why value investing works. But what I found, and a lot of people, you're seeing more and more about this data, is that markets tend to be range-bound after a major mania condition. And after the market has a major mania condition, and I would say the tech mania blow-off qualifies, the market capitulates and consolidates and goes sideways in a range-bound fashion, historically for a minimum of 15 years, in one instance as long as 30 years, to take all the excess out of the market. And the hallmark of being at the end of a sideways market, historically, has been that the market overall goes to a single-digit P multiple. And I have a proof statement on that just because, you know, I think people get that more today. When I first started talking about this several years ago, people, you could just see that everybody thought I was smoking something, like that the markets don't go to single digits, or if they did in the past, we're far too intelligent to let that happen again today. And I think people are starting to get that maybe that's where we're headed this time around. So just giving you a very long history, markets were range-bound in 105 of the last 139 years. So let's look at the last sideways market up close and personal to get some lessons from it. You're not supposed to show messy charts like this, but you'll have to forgive me. But it tells so many good stories, including a Canadian angle. I like to use it. Now, the last sideways market was 65 to 82. And the average annual capital gain of the U.S. stock market then was 0.6% per annum, less than 1%. And back then, dividend yields were much better. They were 4 to 5%. For an average annual return of investing in that market, on average, in that whole time period, of about 5.5%. So that was below long-term average returns. So in a bull market, you get above average returns. In sideways markets, you get below average returns. You add the two together, you get an average market return. Now, what's going on below the surface is the soft gray line, the change in the PE multiple, the price to earnings multiple. And just to bring you up to speed on PE multiples, it's price divided by earnings. Another way of looking at a PE multiple is how many years of current earnings to pay for itself. If you pay 20 times earnings, you're paying a lot. 20 years of current earnings to pay for itself. If it's finally down to single digits, 6, 7 PE multiple, 6 or 7 years to pay for itself. How, you know, that's a cheap market. So if you start on the far left-hand side, you're in a bull market, PE multiples are rising. We're falling in love with the market. It's so much fun playing the market. We're willing to pay more per dollar of earnings to get in the game of investing. And then we blow off. We reach the peak of a mania. Now we have to take the excess out. Market goes sideways in a channel for a minimum, historically, of 15 years, in one instance as long as 30 years to take all the excess out. And the PE multiple always comes down to a single digit. Now, it's P divided by E, price divided by earnings. Now, human beings find falling prices psychologically painful. Now, I'm going to touch on the whole topic of behavioral psychology of finance, which I'm sure you've spent a fair amount of time on. So hopefully I can get past that one pretty fast. But what I would say in terms of proving to you that people don't like prices going down, if the stock falls a little bit and you now don't like it and you want to get out of it, it falls a little bit, you'll sell the stock. It falls a lot, it's painful to sell it. It hurts. So what a lot of people do is all of a sudden they get the patience of Job, they cross their arms, I'm going to wait. and they anchor on the price usually they paid, and I'm going to wait till the stock gets back. I've got all the time in the world. I'll wait till the stock gets back to my price, and then I'll sell. But I'm not going to realize a loss. You see this a lot in the real estate markets. But we do have we did have a favorite trading stock in Canada. It was called Northern Telecom. And you might be a bit young for this, but in audiences where people have lived through that whole Northern Telecom phenomena, a lot of people will nod their heads when I'll say, you've probably heard people say or clients say, I'm not selling Nortel till it gets back to 30, 60, 90, 100, 120, whatever their favorite price was. And people laugh because they know that's what happened to them or their neighbors or their clients, and they didn't sell and they got stuck with the stock. So we do that in the markets in aggregate too. We don't want to sell. And so the price goes sideways by and large. There is some dips. There's more frequent bear market activity in sideways markets. But we leave all the heavy lifting of bringing PE multiples down to earnings growth. And earnings growth is pretty modest. Now, if you read Bay Street and Wall Street research pieces, they make it seem like earnings growth of 10% grows on trees. Every single research report talks about earnings growth of 10%. But in aggregate, I think the study was in 2003, Bernstein and Arnault, dating back to what, 1870, 1875, it's 2.7% nominal, 1.9% real. And if you really step back and think about it, GDP growth in major growing economies is about 3.5%. And GDP equals GNP. GNP is where you take up all the earnings growth of every single business in your economy, and that's your GNP growth. And GNP, and the stock market is a subset of that. And GNP, by definition, equals GDP, so that's intuitively obvious. Now emerging economies like China and India have much higher GDP growth, but when they get big and mature, their GDP and growth will fall to major economy levels. Mm-hmm. No, nominal. It's 2.7% nominal, 1.9% real for earnings growth, and GDP would be similar. Okay. Okay. Well, we'll talk about that later. And so then GDP, yeah. So now I'm going to do the Canadian angle, which is the red line. There's a trade-off between two major investment categories. Financial assets, represented by the blue line, which is the index, and fixed or hard assets, which in this case we're representing with the CRB index or commodities. And when one's in a bull, it has to get the cash from somewhere else. And so it comes from somewhere else, and the other's in a bear. And bull means an up market, bear means a down market, so they move in opposites. So you can see when financial assets are in a bull, commodities are in a bear. They're falling. And then when financial assets, it looks like it's going sideways, but we know the valuation through the PE multiple is collapsing, the commodities are rallying. And the opposite and the opposite. So we will posit that we are today, the market entered a sideways market in 2000, so we're year 9 of a sideways market. In the US, the PE multiple is still 16, so it's above the historical average of 14, and certainly not in single-digit territory. It's not 15 years yet. And since 2000, commodities have been in a rally. Now, it's not going to happen every quarter or every year, so we've certainly had a pullback in commodities in the last year. But in aggregate, you're in a trend line where commodities are likely to rise. Now, what we find fascinating as Canadian investors is historically, Canada has tended to outperform most other major markets in the world in sideways markets. So our returns hover above other major markets in sideways markets because Canada is one of, if not the most resource exposed of all the major economies in the world. And since 2000, Canada, most years, was in the top 3 best performing of the top 20 major markets. And I think last year we were in the top 5 even though resources felt a lot of pain last year, Canada as an overall market was in the top 5 of the top 20 major markets. So we think that trend is likely to be in place if history repeats itself. Now, so I'm giving you a market forecast based on the bottom up. I'm not going to give you a one-year forecast or a quarterly forecast. I'm just saying if history repeats itself like it has in the past, therefore these things might happen. We can't guarantee anything, but that's what's happening from the bottom up. And just not all sideways markets happen at the same time globally, although a lot are correlated. Japan peaked in 1990 and has been in a sideways market since then. In fact, it hit an all-new record low in the last several months. A lot of people believed a few years ago it was coming out of its sideways market. If it would have been by months, one of the shortest sideways markets in history. Now, in equity investing, there's only 3 sources of returns. And this kind of research you'll see if you listen to how Warren Buffett talks. Robert Arnault talks about this. John Bogle talks about this. Quite a few. Jeremy Grantham as well. And so there's only 3 sources of returns. It's earnings growth, plus the dividend yield, plus the change in the PE multiple. And here you can see it at an individual stock level. And then you can look at the history of the markets. And we're using the Ibbotson data, and the data goes back to 1926. And earnings growth is 5.3 in this time period, although you could argue that, in 1926, the U.S. was still an emerging economy to a certain degree. And so you have a nice earnings growth since 1926. And then dividend yields were juicier than they've been recently. Like dividend yields bottomed in 2000 at 1% in North America, and they've been rising ever since, slowly. But now we're getting some really interesting dividend yields. And then the change in the PE multiple. And one of the reasons why Peter L. Bernstein doesn't like the Ibbotson data is because 1926, I believe the market PE multiples was 9. And so because the PE multiple is so low, a lot of people will talk about studies having end date sensitivity. And because in 26, PE multiples were so low, you get over that long time period, you've got an added return purely from the price point you chose. And Peter L. Bernstein actually wrote a piece, said you should actually look at history from similar PE multiples to similar PE multiples so you capture the real growth. And I'm just going to show you a couple more charts that show the volatility, the most volatile component of returns, what John Bogle calls the speculative return, comes from the change in the PE multiple. And for a total return of 10.5% over that long time period. Now there's a recent book called Active Value Investing that focuses in on this sideways market, range-bound market phenomena. And I want to focus in on the range-bound markets versus the bull markets and the 3 sources of equity return. So what is fascinating here is that the earnings growth in both types of market is actually, in this instance, in the periods that he examined, identical. So earnings growth is not different in a bull market or in a sideways market. So that's not affecting the difference in valuation. The most volatile component of the return is he calls it PE growth here. It's the change in the PE multiple in those time periods. And in a range-bound market, it's falling 5% per annum. And in a bull market, it's growing 7% per annum. So that's the big differential. And then you get your stock return, very low in the one case, very, very lovely in the other case. Then you get your dividend yield and your total return. And the interesting thing he pointed out here, and I totally agree with him, is that dividend yields are an important part of total return. Arnault and Bernstein study of '02 concluded over 200 years, 2/3, 63%, virtually 2/3 of your return is derived from the dividend yield and the reinvestment of the dividend yield. So don't ignore dividend yields when investing. But in sideways markets, it becomes absolutely much more critical because it becomes 90% of your total return. And so it becomes a much more critical part of investing. And just to look at this phenomena of the three sources of equity return a different way, I got to know Bill Priest. I thought that this was the best visual depiction of this material I'd ever seen. And so I'm going to share it with you, and I'll explain how to read it. Now, a lot of academics say it's better to look at things over a 10-year time horizon. So each histogram shows you a 10-year return. So the black line shows you the 10-year return on the S&P 500 beginning over 1936, so the prior 10-year return. And you can see over that long period of history that you've almost always had a 10-year positive return. The only exception was for a period of time in the 30s. And then now let's look at the composition of that 10-year return. And the green histogram is the dividend yield. It's always positive. That's a nice attribute. And I like to call it a realized gain. They paid it to you, you put it in your back jean pocket, and no one can ever take it away from you. Unlike unrealized gains, they can disappear pretty fast in a bad market. The second most stable component of equity returns is the blue histogram, the earnings growth. Almost always positive, reasonably steady, fluctuates a bit. But in the 30s, unfortunately, you did have an extended period of negative returns over a 10-year time horizon. The most volatile component of equity returns is the change in the PE multiple, and it's massively trend-orientated. So at the beginning, you have PE multiple contractions. Then you flip to expansions for a period of time. Then you flip to contraction. Then you had that lovely expansion in the 80s and 90s. And now we've just begun to flip into contraction over a 10-year time horizon. And now we're seeing data in the U.S., that we've got, a negative return over 10 years. And we haven't had actually new data coming out showing like it was the worst 10-year episode in financial market history that has happened so far. So that we're in pretty interesting times today. And here's my proof of PE multiples going to single digit. This comes from Bank Credit Analyst, a think tank out of Montreal. And these are all the mini bear markets since the 1929 stock market crash. And how you read this chart, and I want to draw your attention to the PE at trough column, and then only recently I've been drawing people's attention to the far right corner, the rise the next year. So let's focus on the PE multiple story first. So how you read it, look at the top of the chart. It shows 1929 to 1932, from peak to valley, the market fell a very ugly 86%. And after all that death and destruction in the U.S. stock market in that time period, the PE multiple at trough was still an incredibly lofty 26. And so now you enter a sideways market and you go through these little mini bull bears. And so the next drop, the market falls 40%, and the PE backs up to 30. And then the market falls 31, PE is now 25. Falls 54, then PE is now 14. Falls 45, then it's 11. Falls 30, bingo, single digit 7.8 PE multiple. Then how it works is you go one more cycle, and then you've taken all the excess out of the market, and you can start a new bull market run. And what has happened is there's new kids with new money in their back of their pocket, burning a hole, and they start playing the stock market, and they start having fun, and they start making money, and they eventually tell their uncle and their dad, and they all start playing the game again. And then you get this new bull market run, and the market peaks in 65, and then you start to take the excess out again. So then you get PE at trough is 18, and 18, and then 10, and then 8, Bingo, single digits. Go one more cycle, that brings us to 1982. And hopefully you all know the end of that story. That was the beginning of the great bull market run that rallied all the way up to 2000, and I would argue that we, hit the peak, and we've been in a sideways market since then, and we're now taking the excess out, and we're all and it's not going to be over again until we get to close to a single-digit PE multiple or closer to it. Now, the interesting Canadian angle to this right now is U.S. PE multiples are still at 16 on a trailing basis, but Canadian PE multiples are 10. Now, let's not hold on to your horses at the moment because, 10 PE multiples is very lovely, but we're entering some really bad economic patches here, and it's P divided by E, so we know E is going down. So you're going to get a little bump up in that PE multiple. So I wouldn't do any victory laps saying we're done here. I'd like to see that PE multiple with depressed E's in single digits to say, yeah, we're done. But Canada is further ahead of having taken the excess out of the market than other markets. So that's sort of encouraging for, I believe, Canadian investors. And also that the Canadians have tended to outperform other major markets in sideways markets. Yes? Yeah, these are capturing peaks and valleys and peaks and valleys. Because the bottom says stock market declines lasting at least 6 months with a percentage price drops of at least 15%. That's what they've captured here. That's right. It's probably a point in time trailing earnings, I would imagine. Although you always have to dig below in the data and make sure, because sometimes they use current or they use trailing or they use forecast earnings. Always, you always got to ask questions when you're looking at PE multiples. That's why not everybody likes to use them, and you have to be really careful when using PE multiples. Very different than using price to book multiples. Because usually you have to use a financial statement and it's got a year end and you got a little bit more of a strong point. I don't like using forecast or current earnings because that may never happen. Those could be fantasies. Trailing is what happened. So that's not going to change again. So that's why I have a bias towards using trailing earnings. I think most value managers do. I already covered this on the dividend yield, that it's very important in sideways markets. So a lot of this speech was, positioning a sideways market and then saying, well, how you could benefit managing in a sideways market. And time horizons when looking at dividend yields are absolutely critical. So here it's showing in a 1-year time horizon, dividend doesn't look like a very exciting component of the total return, or even the compounding in a year doesn't really add a lot to the total return. But if you give yourself a 5-year time horizon, the speculative return, the noise in a market that happens in a year, melts away. You get the crisscrosses, the ups and downs sort of nix each other out, and more of the return is coming from, the dividend. And that's why when you look at it over long periods of time, and that's why value managers in particular, we say, in our teams, we look at what's the truth long term. I don't care about the short term. That's all noise. And we were talking over lunch. I said, if anybody corners me and makes me bet on anything, I say, you got to give me a 2-year time horizon. There's no way I'm going to win in a 1-year time horizon. There's too much noise. And you know that forecast dinners are very popular in Canada, and then you do it over a year, and so it always makes for fun. Because there's so much noise in a 1 year that hardly anybody's going to hit it on the nose. So, when I get asked to do it, I give them gratuitously a 5-year forecast, and I say, that's probably likely to be more accurate than my 1-year forecast. We already talked about the focus on yield and owning low multiple stocks. When you're in a sideways market, you're going through much more volatility. You're having more frequent bear market activity. And so you're having the market crunch down more frequently. If you have bought low multiple stocks, that's low PE, low price to book, low price to sales, low price to cash flow, they're already cheap stocks. So the overall market gets whacked down. Your stocks don't have to collapse down much to sort of look interesting. And by definition, they tend to have above average dividend yields. And if you push that stock price down, the yield goes up. And some stocks, you'll actually have people step in and buy the stock purely because the dividend's sustainable and the yield's so darn attractive. I mean, that was really highlighted for me in the aftermath of September 11th. When the market reopened in Canada, every stock was down 20 to 30%, with the notable exception of the high-yielding dividend stocks. Stocks like Trilon and Rossmann were like little rocks. They stood still when the market overall was down dramatically. So low multiple stocks don't fall as much. The high flyers really crunch down. So in the last year, what's really crunched down a lot with this market getting dragged down? Big, exciting stocks like, more recently stocks like RIM and Potash, for example. They had a lot of collapse room in them because their multiples were so darn high. They had a lot of thin air to go through. Your returns are very much predicated on the price you paid when you entered. And this chart's saying that if you enter at a high PE multiple level, your subsequent returns are likely to be low. And if you enter when the market has a low PE multiple level, you're likely to get above average returns. And so now we're in a marketplace where, fascinatingly enough, a lot of multiples are lower. I mean, right now in Canada, as of a week ago Friday, the overall market PE multiple that we're looking at here is trailing under 10, price to book below 1.5. Dividend yields in Canada are 4. Price to cash flows 5.5. These are really good levels. We haven't seen much in the last 15 or 20 years. And what are investors doing today? Redeeming. They're taking money out of the market when it's one of the best times to invest in the last 15 or 20 years. And 10 years ago, a year ago, they couldn't run into the market fast enough to put money in the market. And this is trying to capture if you enter when markets are high or low, like we had the market peaking in 1966, 67. You bought then, your subsequent returns are pretty minimal, below average. So you don't want to buy when the market's high. And studies show that by active stock picking, you can get above average returns in sideways markets. In the interest of time, I'm going to pretty much end here with one asset mix. 500-year-old investment advice by Jacob Fugere the Rich. And he was one of the wealthiest men in his lifetime, and he made some of his wealth by selling to helping the nobility fight their wars. By lending them money. He says, divide your fortune into 4 equal parts: stocks, bonds, real estate, and gold coins. And I would caution you that back then there wasn't as much investment choice as there is today, and gold coins was the currency of the day. So if you will, I think you should look at gold coins here as T-bills. And to modernize this, based on the big choice you have today in the marketplace, figure out your own risk-reward trade-off pattern and what would be an ideal asset mix for you. And then stick with that mix through thick and thin. And then he goes on to say, and I think this shows how brilliant he was, be prepared to lose on one of them most of the time. And it's brilliant from 2 perspectives. One is he's setting expectations. That's so important in investing with your clients. Something's going to be in the dumpster. Get over it. That's the benefit of diversification. And he's also telling you something else. Notice he's not stepping in and saying, I've got the secret formula on what's going to be up and what's going to be down, and so you can overweight this and underweight that. He doesn't even go there. He knows that market timing is a mug's game. He's one of the smartest investors in his lifetime. He's not telling you to market time. Now, the next sentence I leave in, not because it's advice, but because he understood the laws of financial gravity, and they haven't changed in 500 years. And I always let that sink in. Like when I first saw that, I went, how did he know that? I'm only just learning that now. And he says, during inflation, you lose on bonds and win on gold and real estate. And that was sort of like what you saw in North America in the 80s and 90s. During deflation, you lose on real estate and win on bonds. That was Japan in the last while. While your stocks will see you through both periods, but in a bit of a mixed fashion. So then he comes back to the advice. Whenever performance differences cause a major imbalance, rebalance back to the 4 equal parts. And that's why I call him the original value investor, because at an asset mix level, he's telling you to sell your winners and buy your losers. And if you do that, you would be a value manager. And what's old is new again. In the last 10 years, there's been a hot academic topic called rebalancing, where people mathematically, for the benefit of the big pension funds, based on asset liability matching, can prove to them mathematically the more frequently you rebalance back to your ideal asset mix, the better your long-term returns. You know, nothing else, just do that, you'll get better long-term returns on that basis alone. And so, you know, he really knew what he was talking about. And what I find fascinating is the Fugger family is still one of the richest families in Europe, despite the old adage that enormous wealth is typically lost within 3 to 5 generations. And I say they still follow their forefathers' advice. So thank you very much for your attention, and I'm open for questions.
Okay, if you have any questions, step at the microphone here. Don't be afraid. Let me ask a question, I guess, as students prepare. What is the biggest mistake a novice investor can make?
Pardon?
The biggest mistake a novice
novice makes. I think they make all of them. I can't think of one. I think that it takes a while to build a skill base, and you're building up experiences, psychological experiences. So everybody's going to make mistakes at the beginning, absolutely. So psychological. And I think that very few people fully appreciate how psychological investing is. And we built into our method all kinds of techniques to cope with the emotions of investing, and that you only can learn to get around it through experience if you work hard at trying to get around those games.
Hi, thank you very much for coming. It was a great presentation, and it definitely
Thanks.
matches a lot of what he's been telling us, so that's nice to see. I was just looking at some of the things that you'd published recently, saying that you had avoided financials, but then I also saw a historical comment that you were actually heavily into financials in 2004-ish. Did you get out in time, and if so, how did you see it coming?
Excuse me. Yeah, my whole career, I had been overweight banks. And, you know, when you think about banking in Canada, since once inflation, the back of inflation had been beaten, the whole banking industry had the wind at their back since 1982. And it was easy to win the game of being a banker. And we had an exposure to banking, and we did well playing the exposure to banking. And then in November of 2007, we wrote a piece and we put it on our webpage, and it's still there, talking about why we feared that, unfortunately, despite our previous thinking that the Canadian banks would avoid a lot of the financial Armageddon that we could see coming down the track for the American banks, that we felt the Canadian banks would get caught up in it too. And we wrote about it, and we struggled to write it. I talked about how it took me, I wrote the piece for 3 months and sat on it because it was so contrarian, and so it was so difficult to get enough material to prove the hunch. And I didn't have proof of the hunch yet, but we knew we had to act ahead of the confirmation of the hunch. So we wrote what we thought our hunches were. And I just read it about a month or two ago, and I think that it was pretty accurate in terms of what ultimately happened. And so we started taking our weighting down, and we did go underweight. But I have to say, being a contrarian investor, you sometimes have to wait a long time to get paid for it. And we didn't get paid for being underweight banks until this last December. Because banks did fall, but the overall market fell too. And banks Canadian banks only relatively underperformed the Canadian market starting in December, unfortunately. But our thesis was that Canadian banks have collateral damage from what's happening in the U.S. They aren't the epicenter of it. They aren't going to feel all the pain that you're seeing in the U.S. The Canadian banks, by and large, will be survivors. But the relative valuation to global banks, our banks are the most have become one of the most richly valued banks in the world. And the relative differential isn't sustainable. But my key argument is that the fundamental earnings power of Canadian banks has been severely damaged, and all bank systems have been severely damaged because securitization, and this is like, I could talk about this for an hour, so I'm trying to crunch it down, but securitization front-ended revenues. The old business of writing a mortgage over 5 years, you would calculate the profitability, and every time the person made a payment on their mortgage every month, then you take a portion of that profit every single month. If you package that mortgage up with a bunch of other mortgages and sell it tomorrow, you could take that entire profitability, assumed profitability, over that entire 5-year period, and you take it in today. And so it front-ended revenues and explains why ROEs were so darn high. And because securitization is going to be hampered going forward in the future, ROEs for banking are going to fall back down to the more traditional levels. And if you plug that into models and say ROEs can't be 20% anymore, but are going to be, we say generously, 12 to 14, but in the short term with a bad economic cycle could fall as low as 6 or even be negative, then the current pricing is too high and they're going to fall. And so we went half-weight banks. We broke our own rule of only being plus or minus 5% overweight and went 7.5% underweight, half-weight. And we'll see how things continue to unfold. But we do not see bargains in banking today. And we'll find out through the fullness of time if we're correct on that or not.
I read a piece in the Wall Street Journal last fall about several fund managers who on average lost like 35 to 40% last year. And one of them said it only served him right because he didn't heed his own advice. He wrote a letter to his investors in spring saying get out of the market, it's dangerous. And I was wondering if it ever crossed your mind to just go home for the next 3 months, wait for the stock markets to crumble, and then buy back all the stocks you held before.
You know, I think what happened for me and for most fund managers is that I started working in the industry in 1983, so I started at the beginning of the bull market virtually. And I like to say to people, I'm Dr. Doom, Mr. Gloom, and I'm always pessimistic, and I say I wear bear-colored glasses, and I caution my investors, like, don't get depressed after having seen me. If you add a dose of optimism to everything I've told you, you'll get it about right. So I know that I've tended to be bearish, but I think of that as a good thing. I say to my clients, I can dream up worse scenarios than you can, and then I try and protect you from it. And that's why I'm a risk manager in looking after your money, because I think the primary job for me to do is preserve my clients' capital. Like, I know, I come from a middle-class family. I know how hard it is to save. People are good, like, you know, the average investor is good at losing their money. They're going to pay a professional manager to at least preserve their capital, we hope. But also, too, as a fund manager, I do not believe in market timing. I don't think anybody can consistently do it well. If you look in history, you don't find anybody who consistently market times well. Like, they might get it right once, but then the next time they don't. They might get out early and not back in early. I don't believe that I can market time well. I know where my biases are. And so I don't think I do my investors any favors by market timing and get out of the market. I put rules on myself and my team to play the game of investing consistently well. And I will break those rules modestly and around the edges, but I explain it to them because I set expectations. I tell them what the rules are, and I'll tell them when I'm changing it so that we're honest and frank with them. But I won't go, I can't market time. I wouldn't get back in. And what I do know now is this is one of the best sets of circumstances I've had in my whole career to invest. To be sitting, I'm fearful the market has another leg down, but I got to be in this market. And so I've taken my cash levels higher than they've been before. But, you know, like in institutional clients, max is 5, and I'm sitting, if the clients will let me, I'm sitting at 6 or 7. And in my mutual fund, I put my own max at 10, but I've allowed it to drift up. I think I'm now sitting at 15 or 16. But that's as far as I will go.
Thank you. Hi there. So you mentioned that you buy companies with very aggressive accounting practices, if it justifies it. So I'm just curious as to...
Rarely.
Rarely. Well, I'm just curious, in these instances, how do you guys measure risk, and how do you arrive at a target return?
Okay, so there's a bunch of different questions in there. And I didn't want to leave you with the impression that I run around looking for aggressively accounted for firms. In fact, we tend to avoid them because they're less predictable. I mean, our favorite kind of stock is a stock that is too conservatively accounted for. They're extremely rare. And when we find them, we get delighted by those stocks. And I didn't mention that in my presentation, I now recall. So we tend to try and avoid the ones that are aggressively accounted for, but because so many stocks have some level of aggressive accounting, you can't avoid them altogether. So it's not something we actively seek, actually. It's something we actively try and avoid. So your other question in there was?
Well, in those particular instances, how do you measure risk, and how would you arrive at a target return if you were to invest in one of those companies?
Well, to me, companies, I mentioned earlier, have 3 major forms of risk: cyclical, operational, and financial, and we avoid financial risk. And financial risk is aggressive accounting. That's one of the risks, because it makes it harder to get an accurate read on the company, and because there's no science that helps you, dice out the stretches of truth to the reality. But there's multiple levels of looking at risk. I mean, managing a portfolio is sector weighting risk, stock-specific weighting risk. There could be certain industry groups are much more volatile. Like if you invest in a forest product stock, there's greater volatility. So reversion to the mean can take longer sometimes. There's multiple layers of risk in investing. I'm not sure I'm capturing them all. But we, using the questionnaire template, we're trying to hit on all the different kinds of risk that could potentially be in a firm. But it happens at all levels. And I think one of the things about investing is that one of the things that it's hard to teach academically, and you have to do it for a long time to feel it, is, to me, it's a trade-off between risk and reward. And the model can say to me, this stock has a phenomenal expected return. Like for example, precision drilling. Now, drillers are incredibly volatile stocks. So using our model and the assumptions we put in, we think that it has a 128% expected return. Wowie zowie! 128% expected return. If that stock did that, what could that do for our clients' portfolios? It'd be fantastic. That's wonderful. That's one side. Okay, the other side is risks. It's a driller. It's an income trust. It has this big dividend yield. Is the dividend yield going to get cut? Yeah, more than likely. It's in the oil sector. Is the pricing's going to move around a lot? Yeah. I get really excited about the return, and I can get terrified by the risks. And we actually, when we write our research reports, we want to delineate all the risks. And the killer in investing is, how do you weigh the two? And how do you still buy a stock when it still has a lot of risk? And yet, the ones that have the most potential return have the highest levels of risk. And how do you figure out and how much exposure you're going to put in your one portfolio to that particular risk, and how you're going to manage it?
Hi. So in your presentation, you went kind of quite thoroughly over the fact that we're probably going to be in a sideways market for a little bit more. So since we can see that the return for that is dreadful, but does it really? First of all, first question is, does it really matter that the market return is stressful, considering as value investor, we care about intrinsic value. So even though like the stock market price might not show the intrinsic value as well, you know, but if you still think intrinsic value is much higher than the stock price, then you should be happy to hold it. And secondly, if it is in the sideways market, wouldn't we be better served buying bonds, since dividend is like the biggest part of the yield anyways? You know, bonds could probably yield better than, you know, the dividend yield.
Well, right now, government bonds probably yield less than a dividend yield, with dividend yields at 4%. But, you know, and I'm no expert on fixed income. I'm a Canadian equity market specialist. Let's put that out there. I like to sort of like, when I'm giving sort of advice out of my sphere of influence, I want to put it out there. It's worth what it is, which is a nickel, right? But given the environment out there, and in the short term, I think we're still in a deflationary environment. But given the massive stimulus packages that are out there, if you have a medium or long-term horizon, and as an investor, I suggest that you focus on the long term, because the short term is very hard to predict. But the long term says to me, goodness, I bet you there's going to be a heck of a lot of inflation, and I bet you you're devaluing the U.S. currency. And so do you want to be out there in a long bond? So you've got to be nimble if you want to play the fixed income. But in the end, I think the best answer is fougere. Be diversified. And I think you should have exposure to everything, and not too much exposure to any one thing. Now, all I've talked to you about is equity investing, because that's my sphere of knowledge and influence. But that does not mean that I don't believe you should be well diversified across all the other categories. You know.
Just about the first part of the question, will you be upset if the market goes sideways for a long time, but then you know the intrinsic value is still over that?
Well, no. I mean, the Brandeis Institute did a study, I believe, in 2003, and they looked at all the existing mutual funds from 65 to 82. And they said, okay, there's survivorship bias in this study. We're totally admitting that right up front. But they said, what was the total return of that group of mutual funds? And they found the quality stock picking managers were able to get about a 9.5% return, which is virtually a normal average market return, when the market return was about 5.5% per annum. So it is possible, if you play a good quality active management game in a sideways market, there's evidence, at least in the last one, that you are able to get virtually a normal market return for investors. And so that's encouraging to me. And the fact that you've stayed invested in a sideways market and you've got good, good low price stocks, and you'll be there for the market timing of the market going back to normal, without timing the market.
Okay, James, last question. Okay, we're running out of time.
Thanks again for your presentation. You mentioned a few minutes ago that you're aware of your own biases when you're making investment decisions, but I was wondering how you approach bias across your firm. I mean, I recognize that bias can be weeded out to some extent through using your models and adhering to strict investment practices, but with intuition playing such a large role in value investing, how do you develop analysts who are able to act on their intuition without succumbing to their human biases?
I'm not sure I fully get the question, because you're saying, your individual team members, and I don't think intuition plays a large part of the method either, because we're identifying cheap stocks and then whether to buy them or not. I mean, what I have found historically is that there's only one, maybe two stocks a year that we'll buy where we're like so excited about buying that stock, and we're like so convinced it's going to make a ton of money for our clients. Most of the stock picks that we make is just cold, hard, rational decision making, and we go, we don't know. And it's only over time that we go, gee, that one really worked. That was great. Like in that year, that stock really came home to roost and really created fabulous returns for us. But in advance, we have no idea, and I'm not sure how much intuition is there. I think that we are trying to take the human emotion out of investing, and perhaps I didn't convey that well enough.
Okay. Thank you.
I want to ask you just one question because I always tend to ask this question at the end of every speaker's presentation. What is the most important thing in investing and in life you have learned over the last 25 years?
What's the most important thing about investing in life in the last 5 years? Well, for me, and I'm going to stress this just because I think I'm not convinced everyone else does this when talking about investing, is that, you know, the time horizon at which you look at investing and human emotions. Like, I think that if you ignore the element of human emotions and their impact on stock prices, then the market will look totally irrational to you. But if you accept that a lot of that irrationality is driven by human emotions, then I think you have a better understanding of how the markets really work, and then you might be able to develop some techniques to take advantage of it. And that value investing is about, you know, in equal parts psychology and fundamental knowledge. And, you know, understanding the human nature is also part of, you know, real life too, accepting human failures, and that we're not totally, you know, robotic, you know, rational beings in any part of our lives, and certainly not in investing.